All right, let's talk about real estate, mortgages, and tariffs. Hey, everybody, Tim Feigl here, and we're going to talk about our market update in real estate. And I'm going to tell you, it's a doozy because there's been a lot of stuff happening, not specifically in the real estate market, but in the economy. And it's time to unravel everything. So let's go ahead and share your screen because you're going to love to see all this data. All right. So, like my title slide says, this is what we're going to be talking about. So we're going to go ahead and review Q1 of 2025 for the local area of Orlando. Then we're going to dive a little bit into the mortgage rates. Then we're going to really look at what we know, economically speaking, regarding tariffs, recessions, and real estate. Which I'm thinking, if you want to know the facts and you would know some good data, stay tuned for that one for sure. So, all right, starting off, this is Q1 review for Casselberry. So for Q1, our median sales price was $364,000, which year over year, we were ahead of $339,900. But as you can tell from last year, we went up higher in Q2, dipped a little bit in Q3, and then dipped a lot in Q4. But year over year, when you compare the quarters, we did pretty well. Now, just in case you want to know why we look quarter to quarter, because we don't have to adjust for certain things that might happen, times the year and things like that. It gives us a good flow of what to expect. Homes sold, though, we sold a lot less homes in Q1, as we were 17 less than what we sold a year ago. But then days on market, if you look at it, we really weren't that far off. Only 6 longer days on average for a home to go under contract. So good thing to think of. Now let's go ahead and jump over into Oviedo. So Oviedo, we're at 525, which was $65,000 more than Q1 of 2024. We did sell more homes in this quarter, 181 compared to 175 a year ago quarter. And if you notice, if anything of a sort, it looks like we're really going to pick up Q2 and Q3 if it looks anything like last year. And then average days on market, though, we did slow down quite a bit as we're at 58 days on average compared to 36 in Q1 a year ago. Let's go ahead and take a look at Longwood. So Longwood, we're at 467 median price compared to 440 a year ago. So we did go up there with a $27,000 increase. Homes sold, we're about right on target, 158 last year, 157 this year. So not too far off. And then average days on market, we did increase by about 19. So not too bad on there. And, as you can tell, looking at these data, it's not as bad as everyone's making it out to seem. It's definitely a different market. You definitely have to work a lot harder to make things happen. And sometimes you got to be patient and stay focused, but things are moving in the right direction. Now let's take a Winter Springs view. So Winter Springs stayed about the same, 420 and 420. Sold homes, we're at 139 sold this year compared to 27 or 127 last year, Q1 2024. And then average days on market did creep up by about 7 days. But all in all, not too far off. So, and then being the fact that we're at 420 and 420, as you remember in past videos I've done, we talked about how we were supposed to be creeping towards 0% increase and not what we've seen in the past years. And this is showing exactly that. Winter Park. So this year we're at 495 for Q1, while we're at 482.5 for Q1 of 2024. So Winter Park did go up. However, their homes sold went down. 254 last year, this time frame, 235 today. And then as far as days on market, we were 47 last year to 58 today. So only 11 days longer than last year. So, all right, now let's take a look at our behemoth, the Orlando area. Currently Q1, we're at 395. Q1 of last year, we were at 385. So we did increase by about $10,000. Homes sold, we sold less this year, 2,135 compared to 2,440. Okay. Then average days on market, we're at 59 compared to 43. That's only shown about a 16-day increase, so nothing too crazy in there. Okay, as you can see, a lot of these numbers, you hear the world's falling when it comes to real estate. Things are bad out there. They're really not. Homes are selling. It's just that things are taking a little longer to sell. So you do have some homes that are on the market for way too long. You have some that are still going quick and get multiple offers. So it's moving to more of a balanced market. Not a bad thing for you, the consumer, the seller, and the buyer. Sellers are still getting out with a good deal. Buyers are still getting a home that they can fall in love with. Now let's go ahead and unlock the mortgage a little bit. So current mortgages right now, roughly, and this was done over the weekend, so it could have changed throughout the day. But as of Friday, it was showing at 6.25% for conventional. FHA VAs were around 5.75%. And then just to point this out of all the deals in the area, 8 deals were seller financing, 7 actually took on assumable mortgages. So some creativity that is happening in the marketplace. Now, here's one thing that we are seeing in Central Florida that I feel, whoops, where did it go? My thing went the wrong way. Well, kind of messed up that there a little bit. Give me 1 second. There we go. So sold terms. Very important. So 50% right here, that's conventional. Cash, 31% of the deals that we're seeing is cash deals. FHA is 15% and 4% is coming at the VA. So as you tell, many people always say is cash is out there purchasing everything. They're not. They're staying about the same. They're usually around 25 to 35%, depending on the city and the area. All right, now let's move on. We're going to talk more about tariffs, recessions, all this economic craziness that you're hearing. And you might have already saw this, obviously, but one of my mentors, one of his big sayings that he uses, which I'm not sure where he got this from, but it makes perfect sense. Headlines do more to terrify than clarify. A lot of headlines that you're going to be reading, they're meant to scare you. If it bleeds, it leads. That's the way it looks in the newspaper industry. They care more about clicks than actually being able to educate. And that's what I'm here to do, is to help educate you on what it means. Now, here's some definite stuff that you might have seen. 6.1 million Americans are behind on their mortgage, the highest in 20 plus years. Brace for impact. Wells Fargo talks about the Great Recession and market indicators, talking about crashes in the real estate market. We're in a real estate bubble, lots and lots of stuff. And, you know, all these are really clickbait. They're trying to get you to look at stuff, get the clicks so they could sell ads. But let's really look at the data and dive a little deeper. Thanks to my friends at Keeping Current Matters for doing the research, getting me some of this data to be able to share. So first off, 82.8% of US mortgages have an interest rate under 6%. So we've been dealing for about over a year with interest rates higher than 6%. As you see right from this chart, not many people are above 6%. So only over 17%. In fact, look at this chart, 33% are between 3 and 4. 21% have the glorious rate of less than 3%. And then there's about 27 between 4 and 6%. But you know, you would think that everyone was above 6 and things were getting bad for them because of that, but you can tell from this data, it's really not. Now just look at this. And this is a big thing when they're talking about brace for impact. We're in a bubble. Homes are going to be crashing and getting foreclosed on. According to this, Americans are sitting on a lot of equity. So, in fact, 68.6% have paid off their mortgage or have at least 50% equity as of Q3 of 2024. So, you dive down into it, 39% don't owe a dime on their home. 29% is greater than 50%, and those with less than 50% is only 31.4%. Now think back to you. Where do you fit in on this one? So that's important to think about. Now, why is this important? Point blank, if you're coming down to where you fall behind on your payments and you have to be foreclosed on, you're in a situation to where instead of getting foreclosed on, you can list your home for sale and you have enough equity to where you're not upside down. Back in 2008, the big issue was everyone that was listing their home, they didn't have the equity available. Because they didn't have the equity available, what would end up happening is they had to short sale or give it back to the bank because they were upside down. Okay. That's not this case. You can sell the home. You will obviously sell it less than what you could do because of time crunches, but you still need to sell the home. And you have the equity available to do so. So you have able to leave with some money versus that time. Now, I know many people talk about how we went up so fast and the issue with that. Well, the difference between then and then way back in the Great Recession is simple. When we were having people overprice homes, buy at a larger scale, the way they did it is they actually brought cash to the table. So if it didn't appraise, they were bringing $25,000, $50,000 to get into that home. Okay. Because of that, it left them with equity. Back in the Great Recession, people weren't bringing the money. They were actually financing it. So they financed it and then ended up upside down to where they had issues. And that's what caused the Great Recession and why we had such a real estate fallout. Okay. Now, recession might sound like a nasty word, but when it comes down to it, real estate doesn't get impacted by recessions. If you look at the data based off the last 6 recessions, in 91, we decreased in home value by 1.9%. In 2008, where we were involved with causing the recession, we dropped by almost 20%. But other than that, for the most case, we grew by 6%. Okay. The market still grew in real estate during recessionary period. So even though we're currently, by definition, not in a recession, could be heading that way, but we're not right now. The real estate market was still climbing during recessions. Okay. In fact, a lot of people believe real estate is recession proof because regardless if you're in a recession or not, you need a place to live. People are going to buy and people are going to sell. Life happens. So, but I wouldn't worry too much about recession forcing homes to decrease because that's not the case. That's not the way things work in recession with the housing market typically. Okay. So rest assured. And in fact, what's going to end up happening if we still have our inventory levels where they are, they're going to end up putting upward pressure on pricing. Because if you only have so many homes out there and you still have the buyers looking, they're going to push up the homes and they're going to cause the prices to still go up because of that. Now, here's a quote from someone from Lori from the Urban Institute. A lot of people have this idea that home prices fall during recessionary periods. There's really not much of a connection between home prices and recessionary periods, other than, of course, the great financial crisis, which is 2008. And we still remember that, which is why it's always brought up, because that was only 17 years ago. Now, good thing with recessions is it does help bring down mortgage rates. If you look during the last 6 recessions, every single time the rates have come down. And in fact, as you can see, 6.25, we're starting to see the rates come down. Even though we're not in a recession, rates are still coming down due to the way of the economic turmoil that we're seeing. So, which is good for everyone because there are going to be some people that might be able to refinance at a lower rate eventually. Who knows? And that could put them in a better financial position. So we just have to wait and see where the rates go. So now let's talk about this. Number of new homes on the market has reached the highest level since 2009. So we have a lot of new homes entering the market. And I always say, like, when you look at stuff, when you see the builders doing certain things, that's a good thing for you as a homeowner because they wouldn't be pushing out homes unless there was a demand for homes. Okay. So, and in fact, more importantly, new builders do not like to sit on homes. So, as a homeowner, if you're looking to buy and you want to buy new, come see me. We can go look around, see what we can find. This will do a great job of giving you the opportunity to get some good deals. I've seen some lower interest rates that the builders are putting out, specials, promos. They're doing everything they can to get you in the door so that you can sell your home over a resale home or buy their home over a resale home. So, in fact, I've had homes that I've had issues with because they're in neighborhoods that are near new construction, challenges from resale homes. So, newly built homes is a percent of all home sales. So out of all homes that have been sold thus far, over 30% are newly built. So that's a pretty big market if you think about it. So, one big thing to think of is knowledge is power. You can read these headlines, they're going to freak you out, they're going to make you nervous. Outside of that, that's all they're meant for. But when you really start diving into the data and understanding what the true meaning is, it's not that scary. You have the power. So let's take a look at this. So listing count. We have increased the amount of listings by 17.3% compared with last year. Think about that. 17.3%. And now for this data, this is looking at the entire state, not just in the Orlando area. But that's our yellow line is us for 2025. And we are higher thus far through March. We're still lower than 2017, 18, and 19, and 20. But we are higher than the last couple of years. And, that's why you'll see a headline like most listings hit the mark in the last 5 years. Yeah, that's true. But when you really compare it to the big picture, it's not a big deal because 2017, 18, 19, and beginning of 20 wasn't bad inventory wise. So again, highlighted the red line because that's really where the big one is for 2020. Now, what if total listings count increased by 10% year over year? We still wouldn't hit 2017, 18, or 19 numbers. Okay. And that's a big thing to think of. Now, I'm going to ask something of you. Go back in your memory and think about the real estate market in 17, 18, 19. Homes were in high demand. We always complained about not having enough inventory. Buyers wanted to buy, sellers wanted to sell. They were selling pretty fast. Now look at this chart. Again, we are not higher than those numbers. So if we were 10% year over year, we're still less than 2017, 18, 19. So it's just we've been spoiled with the last couple of years because it's been a little challenging, inventory wise, buyer wise, fights going on trying to get a home. Okay. In fact, this is a big thing. The market is shifting. Okay. And it's moving to what's called a balanced market, a normal market. Okay. Just we haven't been used to normal in a little bit. So this is not a bad thing at all. Okay. So don't let the headlines freak you out when it comes to real estate. Tariffs, will it have an impact? Yes. Will the real estate still move on and be fine? Yes. Why? Because overall inventory is still low. Just buyers might have to have a little more negotiation power. Sellers might have to be a little reasonable and not look for big jumps in prices like they have been doing. But sellers are still going to make a good penny and buyers are still going to get a good home and live the American dream. So If you have any questions, please feel free to comment. If you haven't already, like my YouTube channel. Hope you enjoyed. If you want to connect with me, you can connect with me through this QR code. There's a lot of scary headlines out there, but the data doesn't show it to be as scary as you would think. Hope that helps. Talk to you all later and have yourself a good week and the rest of the year.